So that's a decent sized banana, but that's the start, right? Because generally speaking, the post-election year, or what we would call crypto fall or crypto autumn, tends to be very strong. So it tends to be very strong. The macro backdrop is obviously very good because of deregulation, new government, all of that stuff. So we've got a good setup. It's gone far and fast. I think everyone's a bit PTSD'd still, so which is why I err towards the it probably has one more squeeze because so many people think it needs the correction now. But you know,
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. Bitcoin has recently achieved a record peak of $97,000, driven by significant liquidity concerns, a robust US dollar, and a rise in institutional interest. The increasing acceptance of Bitcoin among established financial institutions is enhancing its valuation, with projections suggesting that its upward trajectory may lead to further price increases in the short term. November 2024 concluded as Bitcoin's second most successful month of the year, achieving a 37% increase and solidifying its status as a significant asset within the financial landscape. Renowned economist Raoul Pal has advised prudence, forecasting a possible significant correction that may surprise traders. The individual identifies this risk as stemming from market volatility and potential regulatory changes, which may hinder the existing momentum. Pal's prudent perspective is supported by other analysts, including economist Carl Menger, who recognizes the possibility of a market correction while highlighting the overall upward trend of Bitcoin. The technical indicators present a nuanced signal. Relative Strength Index, RSI, indicates that Bitcoin is positioned in bullish territory, implying the possibility of continued gains over the long term, even in light of short-term corrections. Historical trends suggest that pullbacks are integral to Bitcoin's price cycle, frequently acting as consolidation phases preceding the subsequent upward movement. The current rally of Bitcoin indicates a robust combination of macroeconomic factors and enhanced market maturity. The significant involvement of institutional players highlights a strong belief in Bitcoin's enduring potential, although it is essential to keep a close watch on the increased volatility that persists. Market participants ought to anticipate short-term corrections as a natural component of a robust market cycle, presenting potential accumulation opportunities for those adopting a long-term perspective. While Bitcoin's trajectory indicates potential for additional growth, a cautious approach is recommended. Strategically managing exposure through diversification while staying informed about regulatory changes will be crucial for market participants as they navigate the upcoming phase of this extraordinary bull market. And lots of things Raoul Pal discusses, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
yeah, but don't forget we had an 8-month consolidation with a 40% range.
Yeah, that's why I ask.
Right. So generally speaking, it tends to be explosive coming out, the banana zone, right? And I kind of set people up for the banana zone, and here we are in the banana zone. So the question is...
So we're in the banana zone. So we're in... You're saying we're firmly in the banana zone.
How could it not be bananas, right? 50% in a month.
Yeah. How big are the How big are the bananas in the Cayman? Because that's quite a big banana.
Okay, they're not very big here, but... We're not far from a lot of big banana plantations in different islands. But so that's a decent sized banana, but that's the start, right? Because generally speaking, the post-election year, or what we would call crypto fall or crypto autumn, tends to be very strong. So it tends to be very strong. The macro backdrop is obviously very good because of deregulation, new government, all of that stuff. So we've got a good setup. It's gone far and fast. I think everyone's a bit PTSD'd still, so which is why I err towards the it probably has one more squeeze because so many people think it needs the correction now. But I hear your point of view too, so I'm not saying it has to be one or the other, but that's my view. It goes up first. Everyone thinks, oh, it's fine. We're at 110. We're getting 150 now, and then it corrects in everybody's faces quite sharply.
So you're saying
but then
Max
the real
Payne? You're saying Max Payne is another leg up. That's what you're basically saying. Max Payne is sending this thing one leg higher.
Yeah, one leg higher in kind of disbelief, and then kind of trapping a bunch of new entrants in, and then it does the typical 30% correction in a week and a half, and everyone's like, holy shit, what is this thing I've bought? Why did my friend at Thanksgiving tell my cousin at Thanksgiving tell me to buy this? It's gone down 30%. We've got to go through that sort of stuff. Then normally it should rally all the way through till US tax season,
which is April.
So
that's April.
Yeah, it's the March-April period. It usually is extremely strong going into that. And then if it's very strong, then you have a very big correction because everyone needs to pay some taxes. So, and then normally what happens is it corrects again. So you can see it there in 2021. It then had a 50% correction that time. And I'll come on to that in a sec. And then it rallies into year end. I think we're closer to a 2017 analogy, which was a much stronger back end of the year. I think people have real PTSD from last time. And I was actually going through this morning, what was the key factor that caused the stunted cycle last time? It's because the speed the business cycle went up straight out of recession and how fast financial conditions peaked. They peaked in March of 2021, and the market essentially peaked there with the second attempt at rally. 2017 peaked way towards the end of the year. So it was just the weird setup of the post-COVID, inject all the liquidity, then, oh my God, we need to withdraw it. That setup, I think, caused that cycle, while 2017 and 2013 were more similar.
Okay, and
so that means a correction over the summer and then a big rally into year end.
Bitcoin has entered a phase of price discovery, consistently holding above its prior all-time high for almost a month. This stage, characterized by the active engagement of buyers and sellers to determine an equitable market value, has historically been associated with significant price escalations. Don Crypt Trades emphasizes that in past cycles, Bitcoin experienced increases of 1,600% in 2017 and 245% in 2021 during comparable phases. A conservative estimate suggests that a 50% replication of the growth observed in 2021 could position Bitcoin at approximately $150,000 in the near term. Charles Edwards, founder of Capriol Fund, observed that these phases generally persist for a duration of 4 to 7 months, yielding significant returns. November was pinpointed as the inaugural month of this cycle, during which Bitcoin experienced a 40% rally and established new monthly records. Edwards forecasts that December and the following months will present significant long opportunities as the upward trend persists. December has demonstrated robust performance for Bitcoin, especially during halving cycles. Marcus Thielen, CEO of 10x Research, highlighted that December returns during halving years have averaged plus 28%, with significant performances recorded at plus 6% in 2012, plus 31% in 2016, and plus 47% in 2020. Bitcoin is presently valued at approximately $97,000, representing a mere 3.3% decline from its all-time high of $99,645 reached on November 22nd. The asset briefly surpassed the $98,000 mark in early December. Market observers indicate that there is potential for additional upward movement, as historical data reinforces a positive outlook. Thielen highlighted that the current rally of Bitcoin reflects historical trends, especially during halving cycles, which typically enhance price momentum. Despite the prevailing optimism, it is essential to exercise caution. John Glover, Chief Investment Officer at Ledden, recognized the potential for a substantial market correction should Bitcoin fall below critical support thresholds, especially the March 2024 peak of $74,000. However, he also indicated that declines are expected to be perceived as favorable buying opportunities by investors aiming to expand their long positions. Glover anticipates a possible ascent to $125,000 in the short term, provided that current momentum persists and there are no significant macroeconomic disturbances. From an analytical standpoint, Bitcoin's performance corresponds with historical cycles characterized by significant increases during price discovery phases. The observed trend is bolstered by significant institutional engagement, heightened adoption rates, and the psychological benchmark of $100,000 serving as an attractive focal point for investors. Traders must maintain a watchful eye on potential volatility. However, the long-term perspective appears favorable as Bitcoin's trajectory indicates sustained growth potential. With a potential increase to $125,000 on the horizon, Bitcoin demonstrates strong positioning as a premier asset within the digital economy. Let's back to the Raoul Pal interview.
Go back to the longer version of that. Because everyone shows this and goes, oh my God, it's awful. That is a big kind of wedgie pattern. It doesn't look catastrophic, right? It's in kind of sideways range.
Yes.
But my guess is, same way as you, that ETH probably outperforms. And the reason being is you're just going to deregulate this thing. And if you are a financial institution, you will tend to build on ETH or ETH layer 2s. And the reason being, it's like IBM or Microsoft. It's a broad, deep ecosystem. You don't get fired for it. Think of Apple versus Microsoft.
Okay.
Right? There is no investment bank in the world that uses Apple.
Because?
Why? The ecosystem of developers and applications for Microsoft is much bigger. This is exactly the same.
Okay.
So we may use Apple at home. We may use all Apple phones, but the big corporations don't use Apple unless they're in the media industry.
And that's because they feel more comfortable with Microsoft devs in the institutional setting, so to speak.
And you can hire more because there's more around, and there's more applications already been built on it. It's past the kind of Lindy test. So they think, okay, this is the easiest way to do it. So let's say we're a bunch of banks and we want to have some internal settlement system between us for derivatives, whatever it is, right? We're unlikely to use Solana. We're more likely to use EVM.
Do you think you're far down in the road for institutions to be dead set on ETH? Because to me, it also feels like we're really early in the race. Like, I think if you look, I mean, you could argue that very few real world applications have already been built, and so sure. I think we're like in the first mile of the race.
It depends what it is. So if it's NASDAQ, I think it could be Solana or Sui, something, because it doesn't have to integrate. It just needs to work fast, right?
Yes.
If it's something that needs to be settled, processed, clients, systems, accounting, all of this shit, the depth is all there for EVM. That's what's my working hypothesis.
Bitcoin's progression toward the $100,000 threshold continues to engage traders as the target remains prominent amidst indications of market stability. Even with prices approaching historical peaks of approximately $95,000, funding rates across various exchanges are relatively low, indicating a stable market environment as opposed to the excessive activity observed in previous bullish trends. Trader Gell highlighted that the current funding levels of Bitcoin indicate a lack of excessive leverage in the market, even at prevailing price points. In alignment with this observation, Bitcoin Data 21 has pointed out that the present funding rates are significantly reduced in comparison to the 2021 bull market and Bitcoin's peak of $73,500 in March 2024. Observed stability suggests a more robust market framework, characterized by a reduction in speculative activities, which may facilitate additional price growth while minimizing the likelihood of substantial corrections. Historically, high funding rates indicate an over-leveraged long position, frequently foreshadowing price corrections. The lack of these conditions indicates that Bitcoin's upward trajectory could potentially continue to expand. This week's macro developments are likely to significantly influence Bitcoin's short-term direction. The upcoming US labor market data, encompassing job openings, jobless claims, and unemployment reports, is poised to significantly impact projections regarding the Federal Reserve's forthcoming interest rate decision scheduled for December 18th. The CME Group's FedWatch tool indicates that the markets are currently pricing in a 67% likelihood of a 0.25% reduction in interest rates. A decrease in interest rates may lead to a depreciation of the US dollar, which could create favorable conditions for Bitcoin and other high-risk assets. Analyst Allen from Material Indicators observed that a rate cut in December could act as a significant catalyst, potentially propelling Bitcoin beyond the $100,000 threshold, which he described as an early Christmas gift for the cryptocurrency market. On the other hand, should the Federal Open Market Committee, FOMC, maintain current interest rates, this may result in short-term volatility in the markets, possibly causing a BTC flash sale as traders re-evaluate their positions. From a comprehensive viewpoint, Bitcoin stabilization near $95,000 seems to indicate a positive trend. Experts interpret this as a period of adjustment, establishing a robust base for the forthcoming upward movement. The current macroeconomic landscape, combined with low funding rates, indicates that Bitcoin may experience significant upside potential if conditions remain favorable. Traders must maintain a watchful eye, as any divergence from anticipated macroeconomic results could lead to increased volatility, highlighting the critical need for effective risk management strategies. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.